Hey everybody, what's up? Monday, April 27th. Yeah! Market up 350 today. I told you guys a couple of weeks ago, when all that stimulus started to hit, that fiscal support, man, that was big, and you had to be bullish at that time. And what's interesting is there's still a lot of pessimism. There's still a lot of bearish sentiment out there. There's still people expecting the market to crash down below the March lows. I saw today that Jeffrey Gundlach, he's short the market. All right. Hey, I got a treat for everybody out there today. Yeah. Back in 2012, I put together a chart book that looked at the Obama stimulus that was in 2009. Remember, that was the $787 billion stimulus. Well, I put together a chart book back in 2012 that tracked a bunch of economic metrics, like employment, industrial production, oil prices, the stock market, a whole bunch of stuff. And I put together a chart book. I haven't looked at this thing in a long time. I completely forgot about it, actually. At the time it was picked up by Business Insider, that blog, and it had well over 1 million views. 1 million views, man, that was unbelievable. But I put the link right here for you to see for free in the description below. So you could check out that chart book. And the reason why I put it in there is because somebody asked me a question. They said, yeah, we hear what you're saying about the fiscal support and it's massive, but is there any way to gauge maybe what the the end result is going to be? And so I thought, hey, why don't we go back and look at what happened with the Obama stimulus? And I had that chart book, so I'm putting it out there for all of you to check out. Okay? Now, I'm not saying it's the exact same circumstance, okay? In 2008, 2009, that was the great financial crash. It was a financial panic, a financial collapse, which was addressed at the time with financial measures, right? Both monetary policy and fiscal policy. This is different. We have a pandemic. The economy's been shut down. So I guess you can make a case that, hey, okay, there's a lot of fiscal support, but what's that going to do? It's just piling up in bank accounts. If businesses are not open, and if people are unable to go to work, they're not able to spend or whatever. So that is a valid point to make. But at least we have something to take a look at. And by the way, things are starting to open up. Some of these lockdown restrictions are being removed. A bunch of states are starting to, relax these restrictions. So slowly but surely, I'm not saying it's going to go back to the way it was overnight. Obviously, everybody knows that's not going to happen, but we have enormous amounts of fiscal support, and it's really just getting started. I mean, I put the charts out every day to my subscribers daily. Remember, I see this information every single day. By the way, the deficit right now is 1.3 trillion. Remember last week I told you it was 1.1, and maybe in another 10 days or 2 weeks you'll hear it in the media. In the news, everybody be crying and screaming about it. I told you here first, but now it's 1.3 trillion. So this is bigger, not only bigger nominally compared to the last deficit we had in 2008, 2009, but it's also bigger as a percent of GDP. It may not be bigger as a percent of GDP, actually. The other one got close to 10%. I don't know what GDP for the first quarter or right now is going to be, but it's going to be close. It's going to be close. So yeah, go check out that chart book. It's pretty interesting because actually that was a V-shaped recovery. And you're going to see, I point out exactly when the stimulus was enacted, and then you could see the data from that point forward. And it's pretty amazing. It really is, because everything just basically turned around on a dime. So apart from that, we had a pullback in oil today. I understand the jitters and the concerns with regard to that commodity. I mean, we still have storage problems, and this is an issue. On May 5th, I believe, is when the roll begins. That's usually when that fund, USO, begins its roll. Now, they have the majority of their positions in the July contract. I mean, they have a fair amount of positions in the June. They have the majority of their positions in the July and a little bit in the August. So maybe the roll will not be as disruptive as the roll we saw that we just went through when they rolled out of the May. But again, what I talked about last week on, I don't know if it was Friday or Thursday, in that EIA weekly petroleum status report. Remember, I do a full, complete analysis on that every week. There was some signs of hope in there. We saw that for the second week in a row, a pickup in gasoline demand. We saw also for the second week in a row a pickup in distillate demand. All right. The drop in imports now, crude imports at a 28-year low. Now, why is this important? I mean, we need to see some inventory drawdowns. So you combine very low imports with a reduction in U.S. oil production and maybe a turnaround in some demand. I mean, that would be a breath of fresh air for the market if actually, rather than 13 straight weeks in a row that we have saw inventory builds, maybe this week we get a small little draw. I think that would help a lot towards improving sentiment. Anyway, go to my, the link is right here on that chart book. I put it in the description. And of course, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. See everybody tomorrow. Bye-bye.